Today's episode of Full Signal is with Eric Balchunas. He's an ETF analyst at Bloomberg Intelligence and one of the most influential commentators and researchers in markets today. In this conversation, we talk about the boom in ETFs this year, how Bitcoin is taking over Wall Street, and why the Magnificent Seven may not be the concentration risk you think it is. This is a fantastic conversation. I learned a ton from Eric, and I think you will too. All right, Eric, this has been an unbelievable year for ETFs, but we're also seeing a huge boom in leverage, meme coin related ETFs. Can you walk us through sort of the lay of the land here?
Yeah, I mean, the ETF business is a great place to be. It's a crossroads of everything. And this year, I call it the Triple Crown. Record launches, not just a little bit either, by like 40% breaking the record. Record flows by about 30%, and record volume by, again, about 30%. And a couple things driving that. The flows really drive most of it. I would say this is where the fish are biting. So if you have a lot of people who prefer this wrapper, this vehicle, you're going to get more people to actually put their stuff, their ideas, their strategies into it. So now we're with 4,800 ETFs, 13 trillion in assets, and that is a big tent. And I'm pretty libertarian. I'm happy that it's a big tent. There are spots where the tent has to stop growing. Like the SEC just said, no more 3X and 5X. I think that's a good limit there. But for the most part, like you said, like we actually got a meme coin ETF, the Dogecoin ETF launched this year, although it was a little bit of a dud. All the rest of the spot crypto ETFs have been huge hits. Solana and XRP are the top two of day one volume ETFs of the 1,000 launched this year. So that's pretty good. But Dogecoin didn't really do much. So I suppose there is not an unlimited appetite for crypto ETFs. There is some choosiness. And of course, none of those did as good as the Bitcoin ETF. So, when it comes to the meme coins, our phrase is the further away you get from BTC, the less assets there will be. We've made a rhyme. They like rhymes in finance, so we made one for it. And as you get to Solana, XRP, now you get, go down to these less popular altcoins and into meme coins, there are going to be less assets. But the industry is going to try everything. We think 100 more crypto ETFs will launch in the next year. So right now there's, I believe, about 100-ish. And so we're looking to double that in 12 months. And a lot of this stuff won't succeed. It's pure capitalism, this market. They throw a lot of stuff out there. Some sticks, some doesn't. And with the ones that succeed, they harness and try to grow. The ones that don't, they close up. So it's a really interesting time in ETFs. I always think that this is them hitting their prime. But our big outlook this year is that ETFs are living the dream, but some reality checks probably await. The markets won't always be this good. Everything's up. There could be one of these 2X stock ETFs that has an implosion. It's never ever this good all the time in finance, as you know. Stuff goes wrong. So we're bracing ourselves for maybe a little more turbulence next year, maybe not the records not breaking by as big of a margin next year. But this year, in my 20 years in the business, has easily been the most impressive, biggest year in the industry.
That's quite a statement. Something I've been seeing people talk about, there's more ETFs than single name stocks. That doesn't seem like a natural outgrowth of a healthy market. What do you make of that statistic?
I'm fine with it. I mean, look, we have a debate on my team all the time, and one guy on my team has the same. He thinks there's too many ETFs, but you can't get that. You have to let creativity happen in any industry. I will also say, keep in mind, there's 4,800 ETFs. There's 6,000 mutual funds. For some reason, no one has a problem with the mutual funds. There's also more words than letters. And there's more songs than notes. So it's easy to build many things on a limited amount of things. Most of the ETFs, I'd say, are slightly successful or not successful. A couple take off and they're huge. So you could have a million ETFs. It doesn't really matter. I mean, the only byproduct of that I would be worried about is it just puts more onus on the investor of like how to pick one. Like you almost get to a paradox of choice when you don't go to a restaurant where the menu has too much and it's hard to pick. It does give me job security as an ETF analyst, so I can't say I'm totally against it. But even for me as an analyst, there's 4 ETFs that come out every day on average in the US, 10 worldwide. So I even miss stuff, that's like, there's just so many coming out. So it puts extra work on the end investor to have to sort through that and pick them and advisors. But I have no problem with that number. I think that number I think it's used for clicks. It sounds freaky, but it doesn't matter. There's plenty of combinations on a limited amount of things. I always use the dictionary. How many words do you use in the dictionary? Probably 0.1%, right? Do you want people to have go back and not create words? Like, you're only supposed to have the ones that are useful. The other thing with capitalism is you can't just say like buffer ETFs are a big popular area of the market. When those first launched, nobody knew they'd be big. They were just part of the sort of fire hose of launches. So someone right there could have been like, there's too many launches. Well, in that fire hose of launches is the next great idea. But can you get that one good idea without all the other ones? Or do you sort of have to just let capitalism do its thing in order to get those good ideas? And I would say you have to have total creativity in a market in order to get the stuff that really hits and helps investors and is very useful to people. You can't just produce and come out with the greatest things. It'd be like asking a songwriter to only write hit songs. It's not hard to do. You have to just encourage people to be creative and try stuff. And so I can't imagine being a fan of capitalism and being upset about the number of ETFs. Those two things shouldn't really, those should be juxtaposed to each other.
The way that you're explaining this, it reminds me of, there's an old story. It's like, would you rather have a pottery class make a pot every single day for 30 days and use the 30th one as the one to compete with, or have a pottery class just make one for 30 days, and usually the volume will get the best outcome instead of just focusing on a single product. And so my follow-up to this, does anything about the boom in leverage concern you? Because to me, that's the biggest risk in markets is leverage.
Yeah, let me give you some stats though. So of all the leverage ETFs, they make up 1% of ETF assets. It's just not that much. It's like 140 billion. I say just, but of 13 trillion, it's not that much, like 1%. However, they make up 10% of the volume. So that tells me a lot of the leverage is just people trading with each other, like degenning out, my term for degenerate traders. These degens, and some include, by the way, everyone has a little degen in them. I come across people who are pretty conservative investors, and they've got like a 60-40 portfolio, but they like to have a little account for fund money or to speculate. And some like to use these leverage ETFs. So it's not just like young people going wild. It's actually like normal people who just like to speculate on things with a small portion of their portfolio. So they trade a lot and they get a lot of attention because they're sort of, wild and exotic. But again, they are 1% of the whole pie. 136 billion. Vanguard will take that much money in like a quarter. So you got to put things in perspective. Should they exist? Yeah, I'm fine with them. I mean, right now you got 2x is the limit, and there's some grandfathered in 3x, but they're 3x on indexes. So I'm just okay with it. I think right now they're at that sort of like that edge of the tent where I think it's probably like that's enough. But I just think it's like you could take all of your money right now and withdraw it from the bank, and you could go to, I don't know, where's the nearest casino to where we are? They get closer and closer every day. It used to be Atlantic City, but now there's like casinos in, I live in Philly. I could just drive down the street now, and I could put all that money on red or black on a roulette table and lose my entire savings in 1 second. The leverage ETFs, yes, you can lose money quickly, but it's not that fast. You could also bet using DraftKings and lose a lot of money quickly. We're in America, okay? There's a lot of ways to lose money quickly, okay? We just have this culture. And so what we try to do is look, if you want to speculate and gamble, it's okay. Just know what you're doing. This is not the way to build long-term wealth. You'll probably eventually lose this money, but you might have a great time until that happens, right? And if it's only a portion of your money, if it keeps you distracted and keeps that itch of wanting to be in the market and trade while you don't touch the 60-40, that's a good thing, because the ultimate goal here is to not touch your main investments and let them compound. Because if you can just let your stock investments in particular compound beyond year 10 into year 20, especially once you get to 20 years, the compounding is ridiculously good. That's where the real magic of investing is. So anything that can get you to live with that portfolio for a long time, and some people just don't want to sit there because it's like watching a tree grow for 30 years. They want to have a little fun. I'm fine with it. Just be honest with yourself. That's not really investing. That's trading and gambling. So as long as people understand that, I just don't have a problem with them.
Some of you may not have heard this, but our partners at Public just launched something called Generated Assets. It brings AI into investing in a way I've honestly not seen before. Here's how it works. You type in an idea like AI-powered supply chain companies with positive free cash flow, or something like defense tech companies growing revenue over 25% year over year. Public's AI then dispatches a swarm of agents that can scan every single stock, evaluate them, and instantly build a custom index around your thesis. What really stands out is how clearly it explains why each stock is included. And before you invest, you can even backtest your idea against the S&P 500, so you're making decisions with real context and not just guessing. Beyond generated assets, Public lets you invest in stocks, bonds, options, crypto, all in one place. They'll even give you an uncapped 1% match when you transfer your investments over from another platform. If you want to build a portfolio that actually reflects your thesis, visit public.com/openingbell. That's public.com/openingbell. Now let's get back to the conversation. So I agree with you that we shouldn't try to ban these more risky products because I think that's anti-American. But we're also seeing this rise of prediction markets, and now you have sort of the casino in your pocket. And you mentioned DraftKings, you have all these sports betting apps. So that's part of what I'm observing as this broader trend. And how much do you think the regulatory backdrop to all this is influencing it? Because we have a new administration, we have a new SEC that's a little more crypto friendly. How are you thinking about this?
So the new SEC, I would say, is more libertarian, no doubt. Hester Peirce was in the minority. She's a commissioner, and she wrote a lot of the dissent letter when they denied the Bitcoin ETFs. And now the sort of, I say, the Republican or libertarians are in control. And they've been pretty liberal with the crypto ETFs, way more than the Gensler era. However, they just told the issuers they can't do 3x and 5x because the issuers got cute and thought they could tweak the language to come out with 3x and 5x, but you're not really allowed to. And the SEC basically said no in so many words. They told them to withdraw because it was against the rules. So there is a limit. It's not anything goes. On the crypto side, it just depends on how you feel about crypto. I think if you think crypto is all a scam, then it seems like the SEC is irresponsible. But if you think that crypto is, legitimate and has earned its right to be an asset class, then there is no reason not to let ETFs track it, because ETFs, in a way, help clean up an industry because market makers aren't going to deal with any shady exchanges. ETFs bring down costs. So to let the ETF into any asset is like really good for investors. ETFs, like I call the Terradome, it's brutal. Like barely anybody makes any money in that industry. So whenever an asset gets ETFized, it really puts the pressure on all the competitors, especially mutual funds and hedge funds. And so I think it's good for the end investor who wants crypto. The thing with crypto is very polarizing. And so your opinion of crypto is probably going to be your opinion on whether the SEC should approve them. I personally, again, libertarian, and as somebody who has spent the good portion of a year, I'm actually working on a book about this world that I've been introduced to over the past 2 years, but I've been deep for a year. It's legitimate. When you look at how the Bitcoin was designed, when you look at the amount of sell-offs it's come back from, when you look at the passionate investors, when you look at the intellect behind the people and the things that Satoshi brought in when he was building it, there's many reasons that it should earn your respect, especially at year 17. And then you look at the blockchain technology that was taken from Bitcoin, or at least inspired by, and then they're trying to create more decentralized version of the internet, which can be actually drive efficiencies. That's powerful business solutions. So I don't care where you are in crypto. There's a lot of smart people working on interesting things, and I think it's paid its dues. It's basically been around for quite a while now. And so for investors, personally, after FTX, I'd much rather buy it in an ETF than go to an exchange where I'm not sure if the person is like, a 25-year-old who could take my money. The ETFs were a godsend to anybody looking to invest in crypto who's from the normal world, because now you might lose money because Bitcoin could go down or crypto could go down, whichever coin you're invested in. The ETF can't protect you from losses of the price, but nobody's going to steal your money or accidentally lose it or not be mature enough to understand like how to run a business. Like that safety and trust that it brought to investing in crypto is huge. In turn, I've always said, I think the crypto world underestimates TradFi and how efficient and hardcore and price competitive it is. And I think TradFi underestimates crypto in how smart, passionate, young, and some of the technological parts of it are really impressive. And so I've been going back and forth between the two worlds, and it is a clash of cultures, and it's really fascinating if you let it be. But I think both sides underrate each other to a degree. So in my opinion, the SEC was okay approving these. Now there's going to be a point where do they approve like somebody filed for a Trump coin ETF? I don't know. Like maybe they draw the line somewhere. The line they did draw was you need futures on the ETF that are traded on an exchange with surveillance. And right now that includes about 13, 14 coins, but it doesn't quite include some of those others. But the issuers could push Coinbase to make futures of some of those coins. So it's possible the ETF world pushes the crypto exchanges to add more futures. Anyway, long story short, it'll keep expanding, but I promise you, the more crazy it gets, the less assets will buy those. So the market will sort this out. The bulk of the money will go to the sort of major ones like Bitcoin, Ethereum, and Solana.
Something like BlackRock's IBIT ETF for Bitcoin, that's become like the most popular financial product ever, right? Isn't that like it stands alone now? Is that true?
Yeah, it's unbelievable what happened. So I've been covering this 20 years. I've never seen anything like it. I mean, the data speaks for itself. The two data points I'll give you that I think are just most impressive is IBIT actually touched 100 billion. It went that kind of marked the top, by the way. It was like right about 100 billion. And it got there in something like 400 days. The next fastest ETF to get to 100 billion is the mighty VU, the Vanguard 500. It did it in 4 times the time. It was like 2,000 days, something like that, 5 times the time. So it's the fastest ETF to hit 100 billion in under 2 years. That is ridiculous. If you and I launched an ETF tomorrow and we were able to get even 100 million in a year or two, we'd be thrilled. That's 1% of what this thing did. So it's almost like beyond normalcy where it's unbelievable. So if you look at the fund business, it's 100 years old and there's just never been an ETF that has grown as fast as IBIT. Then you throw in the options. It's already, I think, top 10s in options trading, and IBIT options are the largest Bitcoin options market in the world now. Just the options on IBIT, right? So I'm telling you that this marriage of TradFi and Bitcoin it happened through IBIT and these other Bitcoin ETFs. And it's sort of like, it almost like I did a presentation at an event a year ago. I called it a disruptive power couple because ETFs are not messing around and Bitcoin is a very powerful force. So the two of them came together and there's a good amount of synergies off of them. And so that's why I've paid so much attention to this, because even with all this, the Bitcoin ETFs are still about 1% to 2% of all ETF assets. But they've occupied about 50% of my headspace because A, they're new, and B, it's like, it's all happening very quickly and the speed is just breathtaking. And so the idea of this ETF being the way that the sort of normal part of the investing world will be able to get exposure is interesting. Now there's all kinds of byproducts, which is the crypto crowd's now getting like a little upset that like the ETF isn't like putting people on chain. So there's all these other like subplots that sort of like pop out of this that just are endlessly interesting if you're into it. Not like on my team, there's 1 or 2 people who could care less. They think all of it's, just, it's interesting to me that you can have this asset that is like the greatest thing ever. And you still have people who are just they won't even give it the time of day. It's just, the whole thing's fascinating. But what also people underrate about it is Larry Fink runs BlackRock, biggest asset manager in the world. And then Abigail Johnson runs Fidelity, huge. I mean, they've been around since like the 40s. Those two launching a Bitcoin ETF, the amount of like air cover that's given a lot of like advisors and institutions is huge. It's sort of like, well, their name's on it. They're a trustworthy brand. So Bitcoin got a lot of halo effect, I think, from the ETF. And on the flip side, I think the ETF got younger people and different investors involved, because iShares has this great stat. I hope I quote this correctly, but it was something like iBit in the first year brought in 1 million investors. It's a lot, right? And of those investors, 27% of them had never bought an ETF before. And of those 27%, a good portion bought a different BlackRock ETF. So, but this is good for all parties involved. And at the end, it's also good for the end investor, because if you buy a Bitcoin ETF, the expense ratio is 20 to 25 bips a year. Okay, that's all you pay, because the spread is 1 bip or 2 bips. So let's just say that's, of no consequence. If you go to a crypto exchange or do it yourself, those numbers are going to be over 100 basis points in most cases. So the cost compression is also huge, and the liquidity that it's brought in. So you get more of the returns. The reason a lot of people on crypto exchanges are not as fee sensitive is because it goes up 50% a year. So who cares if you're paying an extra 1%? But for the TradFi world, they don't like paying 1% to trade. That's like from 1970s stockbroker. They want to buy something that's like commission free or charges like 1 or 2 basis points. So that's why the ETF really, it serviced all these regular investors in a vehicle they know and trust for the reasons I just mentioned. And so to me, it's one of the biggest stories of the decade.
I know a lot of older Americans, friends and family, who would never touch crypto, but when the ETFs came out for Bitcoin, they bought a bunch of it. And I've met so many people who have said the same story. And to me, that's, anecdotally, that kind of speaks to the entire shift. Bitcoin's becoming mainstream. It's becoming adopted by people that, frankly, want nothing to do with crypto, but because they see the asset price performance, they're going to buy into it. How significant do you think the Vanguard approval of Bitcoin ETFs was?
In the margins. I mean, yes, they have 50 million clients on that brokerage platform, so that can't hurt. That you turn it on, now all of them can get it. I've anecdotally heard stories of people who wanted to switch from GBTC to like iBit because GBTC charges a lot more, and Vanguard wouldn't let them do it, and they left. So my guess is that Vanguard didn't necessarily want to do this, but they underestimated the popularity. I think they thought these would be like a couple billion and that's it, not like 150 billion and not like breaking records. Then I think they probably had their call center get reports that people were leaving. Not a lot, but enough that it probably made the radar. The third thing is, so I think at the margins, your typical Vanguardian investor probably might not be interested. But you can get gold ETFs on the platform, so now you can get Bitcoin. So at least it's there. I don't know how big of a deal it will be in the short term. It just depends on the price performance. If Bitcoin's narrative always gets better if the price goes up, right? Then the narrative starts to be stronger. But I do think over time, as debasement becomes a bigger word in the vocabulary and the government continues to the debt goes up and up and up, it'll be a bigger story. And if people start looking into that and that feeling of affordability and inflation, if Bitcoin becomes part of how to solve for that, then I think it is bodes well that the ETF is available anywhere you want it, obviously. Because when you do have that thought of I want something that the government can't dilute, Bitcoin's cool, its prices seems to go up a lot. I could see people wanting to access it, even some Vanguardians. But generally speaking, they're really conservative. So I wouldn't look at it as some sort of floodgates. But it can't hurt, obviously, to be available on more platforms. So it is ironic, though, because it's possible, if we look back, the Vanguard opening, unlifting the ban, it might have marked this bottom because it was trading around 84, 85,000. I think it's up to 90, so it's not sure. We might go by lower, but it will be kind of ironic if we can call it the Vanguard bottom, maybe. For this temporary bottom, we'll call it the Vanguard bottom. And that's one of the most ironic things you can ever think of, because Vanguard went out of their way to diss it and ban it, and it drove the crypto people crazy. So it's ironic that they came in and maybe provided a little bit enough of a spark to stop that extreme fear that was going on. We'll see.
Well, in the immediate announcement, Bitcoin spiked pretty dramatically, and Vanguard, was one of the last holdouts against these products. So let me ask you about the Magnificent Seven. You've done a lot of work on sort of the idea of concentration versus diversification in the market, but also specifically around the Magnificent Seven. And I think what you've been getting at is something not a lot of people are talking about. So can you walk us through that?
Yeah. So I will say the first time I thought about it this way, the Magnificent Seven, was a guy I think you had on the show, Sam Rowe. Mm-hmm. Yeah. Great thinker, has a lot of interesting ways to look at the market. And he said something along the lines of like, well, each of these Mag 7 or big, I think he might have been just tech stocks in general, they have a bunch of companies within them. And it started to make me think about that. So I was like, this year, we've had some people say, you've got to go to equal weighting, or you've got to you got to underweight Mag 7 this year. They say that every year. And then what happens? Mag 7 just crushes everybody. In fact, active mutual funds this year are underperforming worse than normal. Why? They underweight Mag 7. So every year they do the same thing. I think the CFA has programmed their brains to think, I've got to go to lower valuations. This possibly can't be going up any higher. The reason I think this might be somewhat secular and not cyclical is because if there's like no antitrust laws, it seems like. And so what happens is if you look inside these 7 companies, especially 5 of them, Tesla not so much, but they've collectively acquired nearly 900 companies. Google alone is 250. And when you open up those 250, there's some really good stocks in there. I mean, I use Waze every day. It's a great app. That's just one of 250. YouTube, I use YouTube TV. I realized I used a lot of Google products that just companies they bought. So YouTube, by the way, if you spun it off of Google, would be a top 20, top 30 stock in America. And that's just one of 250. So as these companies get bigger, this is why I think small caps struggle and continue to struggle, is because if the company has something really cool going on, I feel like they just get bought. And someone get bought even before they IPO. And so you've got these sort of like just, companies devouring all the best stuff, the best stocks, the best intellect, the best people, and they're getting bigger and bigger. And our analysts who cover some of these stocks, they're not bearish. They're like, yeah, these are like small countries. Throw in the fact they have a ton of cash. They're not like the 90s stocks because they do have all this cash on hand. And so the other thing that we looked at was the amount of themes. Themes we classify are things like AI, cloud, all this stuff. Usually if it's a theme, it's something progressive and growthy. Well, Amazon qualifies for 8 different themes. So that means you must have your hands in so many growth areas to be 8. The only half of the S&P is even in one theme. Some aren't in any themes. So the average is like, 1 basically, or half of one. Amazon being an 8, I think Microsoft's in like 6. So in other words, they're qualifying for all these different themes because they've got their hands in so many pots, and they're very competitive. They've got smart people, and until they get broken up by the government, I think you have to look at them as the Magnificent 70. And so if they make up 34% of the S&P, you stop looking at them as 7 companies and think of them as like, if anything, you could almost open each one up, list the top 10 companies within the company, put them all in one chart and be like, okay, that's what's 33% of the S&P. And it should make you feel better. And the reason you want to do this is to stop talking yourself into doing dumb things. And this is part of our job, I think, and even an advisor's job, is to just like coach people out of like overthinking things. The mid-twit meme? God loves punishing the midwit. It's like, it's like 100 paragraphs on like the valuations and all this. And then the dumb guy and the sort of Jedi are like, these are good companies. It's just, they're great companies. Search the world. You're not going to find many better companies than these. So I'm not sure why people love to overthink this. I guess that's what investing is. You want to try to find the next thing, but that's our take on it. And, at some point, maybe there'll be a shift, but this is why I think small caps can't get going like they used to, and why the Mag 7 seems to be staying around and even growing year after year when it seems like they should like go away for a while, or at least come down a few pegs. So that's right now where we're at. I say that knock on wood because, nothing stays the same forever. And remember, GE was the biggest stock in the United States for a long time, in like the 2000s. And now I think it's 160th in the S&P. And that, by the way, GE acquired 70 companies total. So we have Google doing 250, Microsoft doing 250, and GE was the biggest company, you can see how much bigger and more full of acquisitions these companies are than the past leaders. Those are the things I just think people should look in a little more, rather than just seeing one stock, one name. There's no way it can be this big.
Real quick, we'll get right back to the interview. Just wanted to pop in and say, if you like this content, I write a newsletter every single morning called Opening Bell Daily. I cover macro, the stock market, asset prices, why things are going up, why they're going down. And if you want to get that for free, you can sign up at the link in the description. Let's get back to the interview. It's like these single names of the Mag 7 are so diversified in themselves, you don't need to buy the rest of the market.
Yeah, they're multiple companies within a company, and it'd just be smart to look at it that way. I think it just takes a little extra work, I think. But honestly, when I looked at how many companies they acquired, I was stunned.
It's crazy.
It is crazy.
Yeah.
No, by the way, if you think this is antitrust issue, I'm not going to argue that. I'm just saying until it is an antitrust issue, it's not an index concentration issue. That's what got me to push back. Because remember, I'm index passive ETF, and people were like, the Mag 7 it's too concentrated. And then that's when we were like, well, actually not really. If you look at them as 70 stocks, it's not really that concentrated.
So one of our recent guests on the show, Mike Green, he's with Simplify. He does a lot of work in passive investing. I know you know him. He came on the show and was essentially saying there's a risk to all the passive investing that we've seen for the last couple decades. And, the Mag 7 have benefited greatly from that. So have a bunch of retirement accounts across the country. It sounds like you're not in the same side of Mike's view on passive investing. Can you walk us through what you're how you're thinking about it?
Yeah, well, first of all, I debate Mike quite a bit, or regularly, I should say. Great guy, great thinker, and I value his viewpoint. I don't fully disagree with him, but I don't agree totally. I think for me, he's going to bring up all kinds of white papers, and I understand. And of course, if flows go into the market, they're obviously going to put bids on, and the stock price should go up a little bit. But I'm a big sniff test guy or eye test guy. And when a company has a bad earnings, it goes down. Has a good earnings, it goes up. And if you look at the S&P 500, right, it's a list of 500 companies. Where they rank is changing all the time. They just had a rebalance, right? 3 companies come out, 3 go in. And then the weighting changes too. So it's like an organic living thing. Why do the weightings change? Active is out there bidding up and bidding down stocks. Active is in control of the S&P 500 weightings. So for example, GE used to be the number 1 stock in America. Passive boomed, right, since the year 2000. Well, GE went from 1 to 150. How'd that happen? Wouldn't it have gone and stayed at 1 if passive was such a big deal? On the flip side, NVIDIA, I believe, was 160th, 170th, 6-7 years ago. Why did it go to number 1 or number 2? Well, active loved it. So active is driving the market. So what I would say, here's what passive does. Passive probably amplifies it a little, because once active does like it, the passive flow is rewarded a little more too, right? But if active doesn't like it, it's going to go down. And then I will say though, it probably amplifies it a little bit on the way up, but on the way down, we found that when there was a couple cases where a stock was really hated by active and started to get sold off, and the indexes that hold it would still see inflows. So it's possible a stock that is just they have a huge problem and they go down 30%. Maybe it would have gone down 33%, but the passive flows buffered it a little bit from going down worse. So I just think at the margins, there's definitely an impact. But until I see stocks not moving on earnings, and until I see the S&P holdings stuck at the same 500 for years, I just think active is driving the car as it should be. The other thing is, if you look at the whole stock market, right, 40% of it is owned by funds. So of funds, about half is passive. And in that passive is smart beta, which isn't exactly totally passive either. But let's just assume it is for now. So that's 20%, right? Maybe some institutions do passive that are in separate accounts that aren't part of the 40. Maybe you get up to a third. You still have 2/3 that is active players, households, institutions, corporations. There's plenty of active players driving the market. Where we do find some issues with passive is in smaller areas like the cash cow ETF, which small cap cash cows. Sometimes you have a small ETF it's like a small fish in a small pond, and the fish grows big. And so in a small cap area, if you have an ETF that catches fire, like the small cap cash cows or the small cap gold miners, sometimes they can actually become a really big holder of the stock because the stock's small. And what happens is the index has to change and become more liberal and like add more stocks in to dilute itself because it didn't think it would get that big. But at these bigger levels of the S&P, I'm just not seeing it. The other thing is, let's face it, we've had markets go up and markets go down well before passive, well before ETFs. There's also a lot of options activities in the market. There's just so many things going on that I think the market is being hit by all sorts of different directions. And the other thing that I think sometimes gets pinned on passive is the Fed put. There's this general feeling that, and I feel the same way, that at the end of the day, because so many people have their retirement money in the market, the Fed will save the day if it ever gets too bad. And so I think the Fed put might have made everything a little more, made it harder for maybe sell-offs to happen like people think. Although 2022 was pretty bad. The market was down 18%. But in general, the Fed effect sort of coincided with the rise of passive as well. And it's hard to untangle those two. Because if you just like, the other thing with passive, and I will say this, is that passive investors are very well behaved. That's the one thing they're different than active. And I think it's because people have married them. And it's because these are marryable products. So a lot of times back in the day, you would date an active manager, and usually it's when they're like at the top of their game. Then they go down, you leave them. It's like dating. And you're always selling high and buying low. It sucks. It was a bad way to invest. But then once Vanguard got index funds down to 4 or 5 basis points, people were like, wait a second, I'll just buy the whole market for like no fee, keep every ounce of gains for myself. Hell, will you marry me? So they completely got married and they're not tempted to leave. They feel like they have the best partner in this Vanguard or index fund or ETF. And it's amazing how disciplined they are. So I do think that is one interesting angle, is that I do think low-cost index funds have cured horrible behavior. And I think that's good. So I would actually turn it on that. It's the active funds that tend to see outflows when they go down, inflows when they go up, and of course some of the thematics and other things around ETFs. But that low-cost beta area, the flows are extremely consistent, because I think a lot of US investors are like, I've got the best product. And I do think a lot of them over the years have been like, they've come to this conclusion that market timing is really hard, if not impossible. So I think a lot of them have just resigned to trying to outsmart things, and they're in the best products. They're not swayed to leave the fund. So like, the hell with it. I'm just going to let my target date fund or my 401k just invest and invest and invest. And I'll check my account in 35 years. Now, I don't see how you could crap on that. That's a very smart way. If you do that, you'll beat all the pros, because you're going to get all your money and you won't have like sold high or bought low, or rather sold high, bought low. Wait, you know what I mean? Bought high, sold low. There you go.
So I think the pushback that maybe Mike would make to what you're saying here, I think passive investing has been very good for the individual. But after listening and reading some of Mike's work, at some point, all those passive inflows will sell when people retire or when they need capital. And a lot of this is a demographic change. So as people start retiring, maybe pulling their funds, I think that was the risk he was alluding to. Yeah.
So, okay, let's go over this. So the first wave of selling will be active mutual funds. Those are the oldest people, the boomers and the silvers. They didn't buy index funds and ETFs. They bought active mutual funds. So when we have them retiring, first of all, maybe they don't cash out. Maybe they just donate it to their kids. Either way, active mutual funds are where the real selling is going to come from first. I've explained that index funds tend to see inflows regardless, and they tend to lean a little younger. Okay, now let's go after that selling. Well, I don't know. Something else may come along. I mean, they have direct indexing, there's tokenization. Who knows what else is going to happen that the young people might be into. But yes, maybe in 40 years when we retire, knock on wood, hopefully we live longer, whatever. When we start cashing out, yes, I'll probably cash out from a Vanguard index fund. But do you think like a 25-year-old wouldn't be interested to buy a low-cost version of the market? Probably. So they should nullify to a degree. So maybe he thinks there's a population issue, which that's a different issue. The other thing he says, which I think, because I've debated him plenty, should the stock market be America's retirement piggy bank? That's sort of, if you really talk to him, that's his bigger problem. And he feels like the government pushed a lot of people into passive and to use the stock market. That's a different issue. So the stock market has a lot of pressure on it. And that's why I think the Fed put is stronger. It's because everybody knows this. And that's a different issue to debate. I don't know if that's a passive problem though. And so I just think what he's talking about is something that would have to happen a long time from now. And we've had multiple sell-offs. And I'm telling you, the passive investors are the strongest. They just keep investing. But yeah, at some point, but I just don't see them all selling on the same day or anything. I don't know. It's one of these scenarios that is just so hard to play out because it's just a possibility. Because then you're looking at different people who bought at different times. Then you've got new generation who might buy the same thing from them. I don't know. I mean, if we had World War III breakout and the market went down 80%, okay, maybe. But then we're like, well, we probably have bigger fish to fry. I don't know. Like there's these scenarios, or I've been dealing with this my whole career in ETFs. There's like junk bond ETFs are going to ruin everything. These doomsday scenarios, they just never really come to fruition. And I guess at some point you can create a scenario that's just so far down the road and so hypothetical that I guess it could happen. Like I will never say never, but we've had a lot of data, a lot of sell-offs, and I don't see anything like that happening anytime soon. If anything, the near-term risk is the 20 trillion in active mutual funds leaving because those are the oldest people.
I think those are very fair points, and I believe I agree with most of it. Eric, where can people find your work online?
If you have a Bloomberg terminal, BI ETF Go. That's the page where we put all our research. You can also find me on Spotify. The podcast I do is called Trillions. And on cable TV, believe it or not, Bloomberg TV every Monday at noon. It's good. By the way, the show's moving to an hour long. It was a half an hour in 2026. ETF IQ. And then finally on Twitter, it's probably where I'm most active, at Eric Balchunas. Those would be the places to find me where I am the most.
All right. I really appreciate you taking the time, and we'll do it again soon.
Thank you very much.
Thank you.